recent string of strong economic reports may have some investors wondering how much further central banks will have to go to tame inflation. Joining us now with more, Robert Both, macro strategist with TD Securities. Robert, great to have you back on the show.
Thanks, Greg. It's my pleasure to be here.
All right, so this morning we got another indication that perhaps inflation's a little bit stubborn, that it's not retreating as fast maybe as some investors may have hoped. And the market has been, I feel, changing its mind in recent days and weeks as to where we might end up this year. What's the landscape right now?
So I think, coming into this year, we started to see a more dovish tone from both the Bank of Canada and the Federal Reserve relative to what we'd been hearing from them over the last quarter of last year. From the Bank of Canada, we saw them deliver a 25 basis point hike in January. But the more surprising element of that was that they did signal that they are ready to pause rate hikes from here going forward if the outlook does evolve in line with their projections. Now, we do look for the Bank of Canada to remain at 4.5% for the rest of the year, but we didn't necessarily expect them to take rate hikes off the table at this stage of the cycle. Similar in the US, following the last Fed decision in early February, you started to hear a more dovish tone come from Chairman Powell and other Fed officials. So neither Powell or the other Fed governors and presidents had been necessarily strongly defending the projections from the December FOMC, which showed the Fed funds rate reaching 5.25% this year. They started to, if not walk back, not strongly defend those projections, and that had markets, guessing whether they would continue to follow along that path, or if they were prepared to potentially stop a little earlier. But over the last 2 weeks, we've started to see some of that be walked back, and what really kicked all of this off was the non-farm payrolls report for January. So when that data was released the first week of February, we saw another 500,000 jobs added in the US. We saw a new multi-decade low for the unemployment rate, and that speaks to a labor market that is continually growing tighter and an economy that's moving further into excess demand. After that, we got a little bit of deja vu last Friday with the Canadian jobs figures. We saw one of the strongest reports on record outside of the COVID period, the 150,000 jobs added, and pretty strong wage pressures as well. So we are now going to find out whether the economy is still unfolding in line with the BOC's projections, or whether they have to, whether they may come back off the sidelines later on this year.
Some of the commentary you'll see when you get these reports will say, well, 1 month isn't a trend make, but for the past couple of weeks, it's been the much stronger than expected U.S. jobs, much stronger than expected Canadian jobs. Headline inflation in the States continues to come off, but it doesn't seem to be any rush to get back down to 2%. Today, you get wholesale prices up 0.7% in January. I feel like we're starting to get a body of work now that might be suggesting that the fight against inflation may take a bit longer than investors hoped heading into this year.
Of course, one piece of data doesn't make a trend, and especially from the Bank of Canada's perspective, they're going to want to see more data to confirm that jobs report. They want to see, GDP come in a little bit stronger than they'd had projected for the fourth quarter and the first quarter before they start to second guess their own outlook. Canadian employment data is notoriously volatile. Some people have, called into question, the accuracy of that 150,000 increase in
and you've done some work on that recently, right? I mean, what did you sort of find out as you started digging below that headline number?
So yeah, we had gotten questions whether there was any abnormal effects from seasonal adjustment or if weather potentially played an impact here. And what we found is it's really difficult to attribute the strength to any one single factor. Certainly over the last couple of years in 2021 and 2022, we saw significant job losses in the month of January because that's when the economy was entering periods or waves of COVID, and you saw more social distancing policies put into place. But if you look at the non-seasonally adjusted numbers, we still saw a much stronger performance this January than any January over the last 20 years. So it's difficult to really blame seasonal adjustment here. Likewise, there wasn't a really strong case that weather played an abnormal effect here. So overall, there were some one-offs, but it's very difficult to fade this report entirely, especially given the performance over the last few months as well, we added another 165,000 jobs over the fourth quarter. So when you look at a longer period, we're averaging about 50,000 a month over the last 6 months, and that's much harder to ignore because it's about double the rate that is required to keep the unemployment rate and participation rate stable. So it does speak to the labor market continuing to tighten and the economy, moving further into excess demand.
This sets the stage, and I think the market's even pricing in the possibility now that even though you said, as the Bank of Canada said, here's the hike, we're going to pause, we're going to take a look at where we need to be, and now the market's thinking, based on some of the data we've been getting, maybe we get another hike before the fall. How likely is that?
Well, like I said, off the top, I do think we need to see a little more data just to confirm that growth is trending above those latest projections from the Bank of Canada. The Bank of Canada has also just released its summary of deliberations from the January policy meeting. This is the first time we've ever gotten a glimpse behind the curtain at what they're discussing and what drove them to that decision in January. So one of the points they made was that to move off the sidelines, they would need to see an accumulation of evidence that the outlook has deviated from their projection. So that's why I think there's a very high bar to move off the sidelines at the next meeting. But as we get further into 2023, if data does continue to come in stronger, if inflation does prove to be a little more persistent, then I think there is a chance the Bank of Canada would have to go again. It's not our base case. We still look for 4.5%, but it's going to put a little more pressure on the bank and going to put a little more importance on the data going forward.
I think next week we're going to get the latest read on Canadian inflation. Any expectations there in terms of what we might see?
I think we are going to see inflation move lower again in January. We're already seeing it come from 8.1% to 6.3%. I think you're probably going to see inflation move lower to somewhere around 6%, but the complicating factor is that energy prices, which have largely driven the deceleration from the highs last year, have now started to move higher again. We saw that in the U.S. numbers. Even though inflation moved lower, it was still rising at a pretty solid clip on a month-over-month basis. And we also saw a bit of a rebound in core goods prices in the U.S. Now, services inflation has proved a little more sticky so far. Core goods contributed to the disinflation we've seen over the last 6 months or so, but if core goods prices do start to rise again, that is going to introduce new upside risks around the inflation outlook and the outlook for terminal rates in both Canada and the U.S.